Welcome to Know Your Options, the Measured Risk Podcast.
The ultimate guide to navigating the volatile nature of the markets while managing risk purposefully.
Join us as we challenge the theory behind traditional asset allocation and dive into the mathematics of investing.
Whether you are a seasoned investor or just starting out,
this podcast offers valuable insights and practical advice to help you make informed decisions and manage your money wisely.
So grab a cup of coffee, sit back, and let's dive into the world of calculated risks together.
Welcome back to Know Your Options, the Measured Risk Podcast. My name is Larry Kriesmer. I'm here with my business partner, Bernard Surovsky. And we have a special guest today, Ben Carlson, who's the CEO and founder of SRA. And that's a specialty administrator in the captive insurance arena. And so this is a little bit off of our normal topic with financial advisors and other RIAs, but really interesting wedge of the business to talk about. So we thought we'd bring in an expert and share Van's experience and insight on this particular space. So as a lead in, there is this ability in the U.S. to, well, actually, I should just let my expert talk about that. Van, why don't you introduce yourself and say hello, and then talk a little bit about what the space that we're talking about is.
You bet. So Van Carlson, founder and CEO of SRA. I've been in risk management for almost 30 years. What we rely on with our business owners is a risk mitigation tool, and that's utilizing a tax code called 831B. Very similar to the 401k, right? It allows business owners to take a deduction, defer the income today under a 401k arrangement. Obviously, it's for retirement. Under an 831B operation, it's for risks that you can't transfer. What I mean by that is when you buy an insurance policy under the property and casualty arrangements between general liability, property coverage, commercial auto, anything like that for your business, you're transferring that risk in the event of an accident or damage to my property. It's going to be covered under this insurance policy. I pay a premium and I transfer that risk to Liberty Mutual, let's say. Unfortunately, there's a ton of risks that you can't transfer. And we know that because, well, a good example would be COVID, right? And there's a lot of other examples I can give. But back in 1986, the 831B code came into existence, very similar to what's happening in the environment today. And it's putting a lot of stress just on traditional insurances. Back then, crop insurance was one of the things that public sector was getting out of, and the farmers found themselves self-insuring crop insurance. You also had a huge increase in liability coverage, liability premiums. It was hard for business owners to get insurance in a lot of ways. I'm talking about traditional insurance. And then now you fast forward almost 40 years later, cell phones weren't even a thing back in 1986. Social media didn't exist. People didn't know what brand protection even meant. Supply chains to now are stretched even thinner than they are ever today because we're more on a global economy we were back in 1986. So really, when you look at the risks that business owners are really retaining, it's gotten a lot bigger. And that's really where the code kind of comes in and kind of takes care of a lot of these different issues. And it's been around for almost, like I said, 40 years. A lot of our clients are, hearing about it for the first time, unfortunately. But I can tell you this, going into COVID-19, we responded quicker and faster for this process, and we helped business out faster than the PPP did. We're telling clients today that live through the COVID that I think all business owners should have a PPP plan, but it needs to be self-funded. And that's essentially what an 831B is. It's taking your taxable income that you would have paid taxes on and putting it away into an 831B, no different than the 401k. You're deferring those taxes, and now you're building that rainy day fund up to handle the risk you can't transfer. And that's really what we do. We specialize in that. We're an admin company. No different than a 401k admin company. You got to have somebody admin your plan, making sure you follow the 4-part test. There's rules and obligations you have to have, no different than 401k. And that's our job to make sure our clients stay within those rules.
Can you walk us through a couple of the challenges you faced early on getting up and running?
Yeah, I literally started this in 2008, and I started really because of the Great Recession. I saw the financial risk business owners took I'd say I talk about it a lot. I loved fourth quarters because being in the traditional insurance market, business owners would call me up and say, "Hey, I'm buying a skid steer, 2 more trucks. What's going to cost to insure?" Everybody was making more money. The insanity part of that was all the business owner did was take an accelerated depreciation, finance the property, and then all he did was bet next year was going to be better than this year. Why? Because now he was carrying debt, and that all came to a pretty screeching halt in the 08, 09, unfortunately. And that's really when I thought, there has to be a smarter, better way of doing something. And I was introduced to this concept, and I watched a gentleman that had 7 of these at the time. He was a major manufacturer of RVs. Everything from motorhomes to trailers and everything else. And he'd been doing these for many, many years leading up to that. And he had cash, and he was the one showing up at the auctions to buy his competitors out. And I thought, this is the way money should be invested, right? You don't buy in the high top of the market. You try to buy, it's so much better and more efficient way to run a business. So that was really our motivation. That was me saying, hey, these are the risk takers. These are the small business owners. They need the same idea as Fortune 500 companies. Now, the big companies have been doing these things for many, many years leading up to this point, 08. So, after that, unfortunately, it took the economy to get better. By 2013, we started getting some really good, I would say, traction in the market. The IRS has won some cases since then, and it really had to do with more of an estate tax abuse program where estate tax attorneys took this product like what we do. Just because it was designed for this doesn't mean we don't get to use it for something else. Attorneys will do that. And God bless them. It was really good estate tax planning. It was too good in the eyes of the IRS, and they've challenged it. They did win some cases. Since then, the PATH Act got adjusted. The 831B came back into existence then. Under what I mean by that is there were some changes made to the law, and basically it said no more can you make lineal descendants owners of these vehicles if they don't own the operating company that they're building the captive around. So that kind of get away from the estate tax planning. But what it also did was when it first started out, you could only do 1.2 million a year into it. They increased it by $1 million back in 2017, and then they put a CPI rider, basically index on it. So this year, for example, you can put 2.65 off the way a year into the plan. Now, there's some actuarial rules. There's some things you got to do on that. This thing requires the box that it goes into is a C corp. It's got shareholders and everything else. Go ahead.
Let me just jump in, Van, because I think you're very experienced in this, and I'm reasonably experienced in this. I actually have some clients that have it, and we manage money in them. Yeah, but I'm not convinced that based on our conversation we just had, people listening will know what we're still talking about. So I'm gonna try and put this down into more layman's terms and just have a conversation about this. So first of all, I heard you mention the word captive once, but mostly it's been 831B, and we should just say that what this is the creation of a captive insurance agency. And the captive insurance agency, meaning the idea that the insurance company is really only issuing coverage to one entity, which is an entity that is captive to the insurance company and is owned by the insurance company. I know there's some risk sharing that has to happen, but ultimately is that a fairly blunt way or,
well,
way to describe it, or have I missed something?
Well, that is the challenge, right? And it's always been our challenge, because when we talk about 831Bs versus captives or whatever, I think if people can have a retirement plan and not be a 401k, you can absolutely own an insurance company and not elect under the 831B, right? The difference is it's a corporate tax, and every year the premiums being seeded into that insurance company will be taxed as a normal corporation. Under the 831B, there's specific rules in order to elect under the 831B, right? So like you wouldn't have to have distribution of risk if you didn't want to take the 831B election. So there's some qualifying elements there. And realistically speaking, I've had to deal with this for a long time, because attorneys that have really embrace this program the fastest, they don't know risk management. I mean, I just talked to one about ISO, and I assumed he knew what he was talking about when I bring up ISO. ISO's Insurance Standard Office, which every state adopts those rules. If you're going to be an insurance company, here's the rules you have to adopt to. And I was kind of shocked that this guy that's been doing this for 20 years didn't know what ISO meant. So there's a lot of challenges in our space. And that's one of the challenges we face is I want to see more risk managers in this space, meaning this is my background. I hire the attorneys. I hire the CPAs. When CPAs and attorneys are out promoting this product, they know tax code. They know the tax. They know, so what are they selling? Are they selling the taxes, or are they selling the risk management that really should be the focus of this product, and why the code exists? And that's been some of the challenges, Larry, is trying to get the messaging precise, because those words get interchanged all the time. And you know it as a captive, but really you can have a captive and not elect under an 831B. It's an 831A actually. And when we have a lot of those guys, we have a lot of guys that have 831As, and because they're doing self-funded health plans, dental plans, short-term disability, some medical plans that help with, so they'll do the A's, but then we'll do
like the one that I ran into is like a large car dealership that does their own little policies on
service
the cars, like service contracts, that kind of thing. They don't actually sell those third party. They actually have their own pool of money that's self-insuring that.
Yeah, they have a TPA, third party administering the plan, but they absolutely own the reinsurance company in the back room. But they had to have an A-rated carrier. We do a lot of those as well, and I love that business. I think running warranty programs through this is a no-brainer. It's a great way to do additional revenue for your business, great way to retain your clients. We work with this from everything from guys that do service contracts under the HVAC systems. Anytime you book a liability in the future and you're taking money up front for it, an 831B is a no-brainer. I mean, you should be able to book that money away, put it away, build a rainy day fund up, and when claims come through, you're just going to push back on that money. So those are great plans. And so those are more of your traditional 831B plans, but there is a fronting company that, a lot of states regulate that because they need somebody that's like a bond company at that point, where the A-rated carrier is basically holding the paper, but they're reinsuring that risk in the back room through an 831B. And those are, again,
I'm just trying to get to high level. So again, the audience knows what we're talking about in a general way. And the topic basically is this idea of creating some form of self-insurance for some form of risk in an entity that you can either elect to get favorable tax treatment or not, depending on what what's important to you as a business owner. Is that a bigger, sort of higher level description?
Yeah, I would say, that's absolutely. You can still expense it out of your operating company. It's just how it's going to be treated in the back room.
I had the pleasure of attending your conference a couple of weeks back, which is just extremely informative. I walked out there going, much more informed on this. So I was thrilled to be able to say it. I was really intrigued by some of the examples you used, like even of dentists who were using this to offer, coverage to their patients. I just thought that was such an innovative use of, offering like a service contract, for lack of a better term.
Yeah, exactly.
So, I mean, can you just share a couple more ideas along those lines that you've?
Yeah, I would. We see it in the accidental damage waiver world right now. A lot of the RV and boat storage units, for example, are springing up, where you got a lot of CC&R requirements, and people are buying recreational equipment right now, but they don't have a place to park it. Well, we can do accidental damage waiver in these storage facilities. If storage unit owners that want to offer their own contents coverage, we do a lot of that kind of stuff as well. Then we talk about the tenant stuff, multifamily space, where if you want to offer some kind of tenant package on that, and so we have a lot of off the shelf products that we work with with certain industries all over the country. Around this time last year, for example, we had issues coming up on death loss on livestock. The avian bird flu was spinning up, and a lot of the traditional, again, the insurance carriers were finding themselves getting out of the market because avian bird flu had spun up so much. So we'd actually came out with a death loss insurance policy where we had specific people asking for this to be able to fund their own risk on on a tax preferential treatment. So, that got spun up last year. This year, we're dealing with ERC. For example, some of these, a lot of CPA communities said, hey, you didn't qualify, but then the third party guy came out and said, hey, you do qualify. And now there's this gap that says, okay, should I have gotten this money or not? And we're actually doing a campaign right now with the CPA community saying, hey, if your client took ERC money, and you may want to do an 831B today, just to be able to put that money away and let the dust settle to see whether or not, because unfortunately, unintended consequences when Congress passes things and the IRS disagrees with it and not everything's written out in the law, it causes interpretations. And, then unfortunately, eventually things will go into court. It's kind of the way that's the way our systems work. I think to me, if I was a client and I don't know if I was supposed to get the max I was supposed to get or a portion of it. I mean, again, there's a lot of unknowns under the ERC, for example. And we're telling our clients, man, if you took ERC this year and you're not sure for sure, you should have got it, or you shouldn't have got as much as you got. I think for an audit protection risk alone, you should be looking at doing an 831B. And because Wall Street's writing a series of articles on it right now. There's some contention there with even with existing CPAs that I've talked to that they got to go back and amend these returns, and they don't really think the client would deserve the money. Now, are they going to sign that tax return? There's a lot of things getting spun up in that world right now that we're seeing. And again, if you can just park the money off to the side for right now, I think an 831B is a great vehicle for that.
Mm. Can you talk a little bit more about, when I was visiting with you guys, the opportunities in terms of the tax deductibility on the money going into these plans from the corporate side of it, and how it's not taxable itself to the 831 plan? Let's talk a little bit about that and how one can take advantage of that.
It's very similar to the 401k, right? So you're expensing your contributions under 401k, you're expensing your premium you're going to write to your 831B. And of course, 831B, no different than 401k, doesn't pick that up as income, right? So it's not taxable under the 401k umbrella. It's not taxable under the 831B umbrella. What is taxable is investment income. So like dividends, that you would receive, or if you sold stocks and you had realized gains and all that kind of stuff, you always pay realized investment gains under that arrangement. But it's at the corporate level and all that good stuff. What is not taxed though would be the premium, right? This is a C Corp. So down the road, once there, it's eligible for qualified dividend distributions. If the client says, hey, I sold my business, I'm going to shut this thing down now, obviously it would come out as long-term capital gains. So there is some tax arbitrage going on in there as well, depending on where you live and what the current corporate tax rates are, right? So, so that's that's a big advantages to this program is that, the big knock on C Corps obviously is the double taxation, but the fact that the premium, let's call it $1 million, you put $1 million every year into this thing, it doesn't pick it up as taxable income under that inside that box. And that's, again, it's going to earn money. It's, we expect clients, just like you said earlier, Larry, you're managing some of these accounts. We absolutely expect this money to be managed by their financial planners. And it does, does a lot of things for clients, not only have risk mitigation, but long-term planning that you guys can do on the back room, I think is a substantial big advantage to business owners as well.
What direction do you see the captive insurance marketplace going in? And are there any recent legislative changes that kind of make you excited or less than thrilled?
Yeah, the IRS came out with some proposed new regulations on it this year relating to the 888 filing, which is a transaction of interest or a listed transaction. We're not worried about that. We've been doing that for a long time now. We've been doing it since 2016 tax returns, applying those documents, additional required paperwork for the tax returns. I have no problem.
Again, for the uninitiated, that's basically forcing the taxpayer to raise their hand saying, I may be engaged in something that requires closer scrutiny.
Yeah.
That's exactly. Basically, exactly.
Yeah. But like I said, we've been doing it since 2016 tax return. There was a notice came out back then that required us to do it. It got challenged in court that the IRS didn't follow the proper procedures for this listing transaction. And basically they actually lost it to the Supreme Court 9-0. that they did not follow the proper procedure. So now they had to go back through the procedure, and we just finished up with comments middle of July of this year, and you can ask. Actually, SRA made several written comments to the IRS under the code. There were some things in there that, are they making policy or are they making law? There was some questioning about that, but nevertheless, it is what it is. I think right now, given where we're at in the market today, I mean, look at California. California's lost 3 major carriers right now: State Farm, Allstate, Liberty Mutual just pulled out of all their commercial insurance, which means they're not writing new business for commercial insurance, which they own a big conglomerate of many different insurance companies underneath that umbrella. And so it's going to make it much tighter in the market space. I jokingly say this, your insurance policies are getting bigger. The reason why they're getting bigger is because there's more exclusions in them than ever before. When you look at the COVID situation where there's close to 10,000 pending cases right now in court where the insurer is suing the insured that they didn't cover them for business interruption, they're going to lose all those cases, meaning that the business owner that brought lawsuit against their carrier that they thought they had business interruption coverage for under COVID didn't trigger coverage, and there's specific exclusions in there. And the reason why your policy is getting thicker is because, again, it's the more they have to put in exclusions. So, if they offer you more coverage, right, they don't necessarily put it in the policy. They only put exclusions in policies. So that market's just going to keep getting tighter. Prices are going up. And then the world's gotten much more complicated, right, since this code took off. Again, what is the plan for the Congress on the next go around? Are we going to do PPP again? Are we going to do ERC? Unfortunately, we're going to see a lot of fraud cases come out of that. And, writing a $6 trillion check out in the world to make believe money, I don't know if that's really good for our economy. I think we're still feeling the ramifications for that. You had the Maui fires, which puts a ton of pressure on the reinsurance markets. Insurance markets are like banks. They're like, hey guys, I need a rate of return on my money. If I'm not getting it, I'm not gonna take the risk. Well, when you can sit around and get a corporate bond right now for 8-9% and not take any risk relative to the financial risk of that corporation, but meanwhile I'm going to put up money to cover more catastrophic potential claims, and for example, what happened last week in Florida with the hurricanes. So I guess what I would say to you, Bernard, is I think we're in a great as far as what we're hearing and seeing and dealing with, taxes aside, business owners are concerned about the risk and the fact that they're not finding the risk that they need to cover. When we look at COVID incidences, when we look at cyber today, when we look at supply chain risk, social media, the brand protection that goes into business owners and how much money they put into their brand and how quickly it can be destroyed, either through their own means because they made a mistake, or they have a disgruntled employee. We had a restaurant where a disgruntled employee went out and made up 15 fake emails and nailed them on Yelp. And they couldn't understand. They went from a 4.5, 4.6 down to a 2 because all of a sudden they had 1-star negative reviews, and that's just from one disgruntled employee. So when you think about the craziness of that and the complications that brings, I think to having business owners never had an incentive to save money. They've got all the incentive in the world to spend money.
Yeah.
This is a first code that really allows them to build up a rainy day fund, a war chest, whatever you want to call it, and hopefully you never have to use it. Like every other insurance concept, who wants to use insurance? I can't think of a good situation where insurance is being used ever in a situation.
Well, insurance. Let me address insurance too, because I think there may be some people out there that are going to maybe inquire about 831 and about captives potentially and the language or whatever they're using. And let's talk about the primary abuse in this area, because I think it's important to address it so that people know what maybe to for sure look out for. And my understanding was that, again, conceptually, you form your own insurance company, self-insure your risk. You can accept a very large tax-deductible expense from your corporation, tax deferred in your captive insurance agency or in your 831B. And then there are taxable interest things happening over in the 831B. So the cure for that, quote unquote, was to invest in corporate-owned life insurance. And they would take, promoters would basically take all of the premium and buy a very significant amount of life insurance, which then had a tax wrapper around it and would generate no tax liability and create a huge pool of tax-free money in the event that the business owner was, to die or something. And this is presumably also tied into the, let's say, overly aggressive estate tax attorneys who could then structure it in a way that tried to make that life insurance death benefit estate tax free for the beneficiaries. So in a nutshell, I think that's the red flag that was waved in front of the IRS bull and has caused the thorny horns to come out and fight this thing. So if we all know what that is and we address it, that is clearly abusive, and we look to what the tax code was developed for to allow for appropriate mitigation of risk through a business owner and not push that envelope so hard that you run into trouble, then I think that's a great basis to start a discussion about whether or not this makes sense. So let's talk about the parameters. I know that, admin companies aren't cheap, and and I know there's a $2.6 million funding cap, but where does it work practically on the small side of things? Let's talk about the sort of the threshold to get into a cap.
Yeah, that's a great question. I saw some real challenges in that, right? When I first started, I was like, man, $250,000 to form one of these things. And if you weren't doing north of $1 million in this thing, it didn't make any sense. And I thought this isn't helping the small to middle market business owners, right? So we were very conscious about that. And what I wanted to, for example, it costs $6,000 to form an 831B plan with this, or this arrangement, a captive arrangement, where you're starting to self-insure your own risk. So that builds the box, $6,000 a year. And then there's some retained liability because we operate very similar to the automotive industry, where we have a fronting company that will underwrite the risk, issue the policies back to your operating company, but then we're going to reinsure that risk in the back room. And that reinsurance company is an 831B plan that the business owner would own. So that's how we operate. And I think that lowers our fees down drastically because of that. And we do some retained liability. So we go as high as 10% if you're doing less than 400,000, and we go as low as 3%. And that's really for the guys that are doing north of $1.6 million a year in this program. So our fees are very manageable. We do it in a way that the client needs to win first. And that's our focus. Everything else should take care of itself. And you guys are like-minded on that, right? I mean, the client's got to be the winner here. Everything else will take care of itself, right? I mean, it's just the world we should operate in, right? And I know you guys do. So that being said, for example, when the client can't fund that year, the most it's going to cost them is $6,000, and that's going to come out of the plan. So, that was a big thing for me, Larry, when I first looked at this, because what was happening in 08, 09, 2010, guys had these plans, but they were still costing $40,000, $60,000, $70,000 to have, but they weren't putting any money in it. And I'm like, well, what are you doing for that as an admin company to charge these? Those are ridiculous fees to me. If you're not issuing new policies, underwriting new risk, going through certified audits and all those other things you had to do, what additional costs were you getting to? So it just felt like a money grab, because you can, they did. I didn't want to run the program that way. So, now I have clients, and Bernard, you brought up dental practices. I have dental practices that do $40,000, $50,000 a year in these things. Why? Because it's a hell of a lot better than a 401k. They can't get these are guys that are making $300,000, $400,000, $500,000 a year, and they can't max fund their 401ks. They don't have enough people contributing to it, so they can't even get there. And meanwhile, they can do an 831B. They can, warranty all their hard appliances that they're putting in, the bridges to crowns and everything else. And it's a great program for them. And this becomes their own nest egg. And then, of course, we got guys that they'll do the max. I got guys that will own 3 or 4 of these things for a variety of reasons. These are 100 million plus year revenue companies that unfortunately have a ton of retained risk. So I would say, but the fees work in a way that is manageable for all the small and middle market business owners. We believe this will become a normal business practice, not because of the tax place.
And I think if we do the math a little bit, Dan, just to see how this works, let's say there's a $6,000 cost and it's a minimal contribution. Let's call it $100,000 as a number, right? So $6,000. What's that?
It's going to cost them $16,000 out of that year.
Okay, because you do a 10% of the 100,000 or something.
Yeah.
Okay, so And then you get 84,000. Are you taking it out of the 100, or you take it, or where does that 16,000?
The 6,000 in the 6,000 in the first year, you're buying shares. So that's actually coming from the client themselves that are buying the shares of the C Corp. Okay. But after that, it does come out of the reinsurance company, or the 831B plan, I should call it. Okay. It's going to, the 6,000 ongoing fee, because there is an ongoing fee on that too. So that pays your domicile fees, it pays your tax returns. If you financial reporting, everything like that. It's one and done. There is no nickel and diming. If you call us, it's all inclusive, all the services we provide our clients.
So in a little bit, you can think about this almost in the way that I hate to go back to the cash value life insurance, but a cash value life insurance policy also has relatively front end loaded fees, and it isn't for a couple of years before it starts to perform well as it sort of overcomes its initial cost. And the same thing can be looked at for the capital inside of the 831B. Is that your first $100,000 gets nixed pretty hard. The next one, maybe not as badly. And then the more you accumulate, that fee roughly is staying relatively static, because you're not paying the fee on the capital in the account. You're paying the fee on the contribution.
That's exactly right. That's exactly right.
So there's a point at which the more you make these contributions, then the relative cost gets lower and lower and more efficient for the asset. So that's why it makes sense. So if anybody's listening, it sounds like a tremendous fee to pay. Again, it's a fee on deposit, not on capital. So you have to pay attention to that over the term.
Well, yeah. Something I just want to add, having gone to the conference and seeing how many people you had standing up there, with all your shirts, and I was like, wow, I mean, this is, you really have a fantastic organization there. So it's, it's not like it's just two people sitting behind a desk trying to push papers between each other. There's definitely, a lot of structure to your organization.
No, I appreciate that, Bernard, because you're right. I mean, we try to be very conscious of what we're charging, but at the same time, what we do, takes very good dedicated staff. And so, and we do have a very good team. But, when the clients first hear about this, Larry, to your point, they're like, oh, geez, that seems a little rich. Well, let's peel back what a 401k costs you. Very similar in cost structure, actually, right, for administration. So to me, it's like, I always tell clients, if you have a 401k, the 831B allows the 401k to still be around, because, when you do get hit with these unforeseen incidences where you're just pulling money out of cash flow to make good on it. One of the things we're seeing right now is high deductibles. Business owners are taking high deductibles right now. Well, if something happened, where's that money going to come from? All that money is going to come from is cash flow. And that's a dangerous place to be in. If they get hit at the wrong time, it's the difference between living and dying, right? So, these are structures, these are fees. And again, I think we call ourselves a low cost provider with the 5-star service. And I think that's, again, after 80, let's take the 84,000. If you're living in California, you didn't take the deduction, you had $84,000. Well, how much of that 100,000 did you have left? Right? Between state income tax, federal income tax, and everything else, our fees are still winning. Now, down the road, when you declare a dividend, down the road, that's where the arbitrage comes in. Does it work still at that point? And that's really what we kind of focus on, is our fees in line to where our client can still win on that. And typically they'll save anywhere from 8 to 12% if they said, hey guys, we're out in the first year. We don't like it, whatever. Our client would still win. Now, to your point, this should be a long-term strategy. The longer this money sits and goes into that, I think you're absolutely right, Larry. I think overall our client will win, but it should be looked upon as a long-term planning strategy, not a short-term. But even as short-term, they win a little bit.
And I think if you look at it in terms of, and I love sharing this with clients, you already have a plan. Everyone out here who doesn't have an 831B plan already has a plan. They're just self-insured, and there's no sinking fund, right? So they've already made a decision. The risk is still there. And so, as you were saying, I was going to bring up the same thing. If the contribution calculation turns out, and you guys have to do actuarial numbers, you just can't willy-nilly pick a number out of the sky and make a contribution. So there is some work that you're doing also to advise the clients as to what's fundable and what kind of limits you can have. So let's just say that $100,000 is the annual risk that is reasonable to form a premium for. That is, they don't know it, but that's their self-insurance premium that they're not able to take a deduction for. And in California particularly, maybe you have 58 to 60 cents left of a dollar after taxes. If you're in the kind of income level that's generating that kind of responsibility, then you're definitely in that top bracket.
Absolutely.
And so you're going to have barely any leftover capital. And then, there's no sinking fund to actually cover the risk. So I think it really does make sense to at least consider these things, have a conversation with your advisor, call your firm. By the way, how do we find you? How does somebody listening?
I would tell you to 831b.com. We've made some very educational videos on there. I think, this is one of these tools where you work on it, not in it. Business owners got to get familiar, and I think they have to go around and do a lot of due diligence. And again, this is a tool in a toolbox for business owners. For the right client, it's a fantastic tool. But I would tell you to go to our website, 831b.com. And that's a great place to start. We got resources there. We got tax resources there. We've got case studies. We've got videos, animation videos that I'm told by Bree that we have to have because that draws people's attention is watching animation videos. We pay for those. That comes out of those fees too we charge. So anyway, but that's a great start to us. And then of course you can reach out to us off that website through contacts. And then I would say we have about 200 advisors around the country that represent our products. I've got a very good in-house sales team. And really when I say sales team is, when you're educating, you're selling, I guess, but really we educate first and we want to make sure our clients that get into these types of programs fully understand what they're involved in, because to what you brought up a little earlier about the risk distribution, you will potentially pay claims that are not your own. How's that work and how's that happen? You need to fully understand that. And again, we do a good job with that. We manage that risk very effectively and efficiently for our clients. But those are pieces that I think business owners really have to understand to jump into this type of a program.
Yeah. Well, as you probably know, we do manage money for captive insurance agencies. Our specialty happens to be risk management on the investment side of things. And so we have the whole thing of measured risk portfolios is that we have a very unique model that can attempt to generate equity-like returns with a significant amount, well over the majority of the portfolio held in treasuries. So that we have a very liquid pool of money to meet claims if need be, and also the ability to provide a pretty reasonable growth on the portfolio. But if you're listening to the podcast and you're either a business owner or you're an advisor who doesn't know about these things, you can reach out to us at Measured Risk because we're reasonably capable at talking about this. You can also reach out to Van Carlson at SRA or 831b.com. and get more information about it. Because I think if you don't know about it, you've got a big hole in your arsenal of how to manage the risk. So, I
do want to say this: what you guys do fits very well for us.
Yeah, exactly.
I like it. It keeps it liquid enough, but you guys are able to put some juice on the back end. I like it. It's good. It's good. Hey, it's good business. And the more ideas we can bring to the risk takers, the small to middle market business owners, because they just don't know, the better, right? And it makes us stronger as a society long term. So
exactly right.
We both have really good missions.
Exactly. And to be clear, we work with other advisors. So it's not like we're looking to remove the relationship.
I know.
Support it and help other advisors learn how to bring this type of management to it, but also help other advisors learn about the process. So that's great. Well, Van, this has been a great chat. Is there anything that we didn't ask you that we think we should have asked you?
No, I think you guys did a great job. I appreciate the questions, and you guys are definitely insightful on it, and it's good. It's going to be an interesting next several years anyway, right? It always is. It seems like so. Exactly. We're excited about our growth, and we're excited for working with you guys. Appreciate you getting me on your platform.
Similarly,
thanks, Van.
Thanks, Van. Good talking to you.
This interview also may contain statements that constitute endorsements of measured risk portfolios, also known as MRP. Please note that any such statements are not made by clients of MRP, but by representatives of other investment advisory firms that work with MRP. No compensation was offered or given in exchange for these statements. However, a conflict of interest exists due to the incentive to give an endorsement in the interest of a good future working relationship between the endorser and MRP.